Hey, how's it going? It's Jonathan. Welcome back to another video. So today we're going to take a look at some technical analysis. Now I'm not going to say we're going to do anything complicated, so keep it to the simple support, resistance, price extensions, price retracements, etc. So keep it really simple. And we're taking a look at the technical side of things today because we have the 7th turn date coming up basically tomorrow. So today is the 6th in Australia, and I'm sure by now it's the 6th in the US. So 7th is tomorrow, and if we're going to get any form of bounce, tomorrow is where I'd be expecting it. Of course, we could still go down lower a little bit longer. I will go over the charts in a second. But for those of you in the back end, I just want to remind you one of the comments that I made to you, just so that you remember where we are, okay? So I said in the final comments about 2025, I said that we're expecting a top to be between 2025 and 2026. Others are suggesting it out to even 2027 and beyond. The reason why we go for 2025 to 2026 is because that's when the North Node moves between 0 degrees Aries and 15 degrees Pisces, which is our sensitive degrees in the zodiac for the North Node. So I detail that fully in the McWhirter program, where I break down the cycle and go over where the cycle starts and finishes. So it's just important to note that while we do put out these forecasts, while we do say, look, the market can be bullish, we are in a year of ascension, we need to be aware that external factors can influence it up and down, above or below where we think we're going. And while I try to keep a level head, we may not be able to call the top to the day, but we just need to take a look at everything that we have right in front of us, okay? So as we know right now, we have basically all the markets around the world are basically tanking right now due to the tariffs, and it's basically just causing uncertainty in the markets, okay? And I want to say uncertainty because we're not really booming in an 18.6-year sense. We're not really getting that blow off top just yet. Yes, the markets have risen, but it hasn't been like hyperbolic where everyone is really chasing this market higher. Not kind of like what we see in cryptocurrency where there's no end to this, you know. Back around 2020, 2021 timeframe, where everyone was telling you if you don't get cryptocurrency, you're a bloody loser, all that sort of stuff. We didn't really get that in stocks where everyone was piling into stocks, okay? So that's what I'm trying to see, and that's what I'm hoping to see, is we're getting that piling in. And that's kind of like the topping signals, okay? It can happen 6 to 12 months beforehand, but I wouldn't say that everyone out there has been really piling into stocks. They've been saying, oh, I'm a bit feverish, I'm a bit concerned about the markets. And, you know, super funds are obviously holding these, and I don't know, 401ks or whatever it is in your country, the equivalent. But we haven't really had this blow off top, at least not that I've seen, and maybe I haven't been looking properly. So let's just take a look at the charts here. Now, there are a few things that I want to go over with you today. So we're going to take a look at the current decline. Now, the current decline from the top is 15.2% or 15.1%, depending on how accurate you want to be with this. 15.2% decline, okay? Now, we're going to keep that in mind because we're going to go over some prior crashes, and we're going to try to keep this in context, okay? Because the context is that we're at the end of the 18.6-year real estate cycle. So we want to see, is this decline something that is, you know, something to be concerned about and something that could be prolonged, or is this just a sharp decline which is just going to reverse very, very soon? That's all stuff we need to be considering. So let's move on. Let's take a look now at some Fibonacci retracements, okay? Because this is going to give us an idea on where we are now and where we're probably going to be heading soon. And I'll also put on the trend line, and I'll pop on some rectangles. And I'll also pop on this one too. So what I have here is I've got some Fibonacci retracements. So I've got one which starts in 2020, and I've got one which starts in 2022. So this is the low in 2020, and then this is the low in 2022, and they both come up to the top in 2024 to 2025. Okay, so this is where they come up to a top. Now, on the way down, we can see levels where these are breaking up into their portions of 25%, 38.2%, 50%. I've got also the 75% level, which is again number. And I've put these little boxes on here where we would be expecting the major levels to be giving us some form of support or resistance. Now, the very first critical point we're going to point out is this 25% level, which is the reversal that we had last month. Okay, so the markets came up from here. This was our time by degrees date. This was the price level. The markets came down, reversed off it, and started to move higher. That obviously didn't last very long when Trump came in. This is the second date here where we stayed above that 20%, 25% level. That was the 31st of March. However, we can see we broke it. We gapped down, strongly broke it, closing below that prior low, and then we've gapped down again, and we have broken it, and we're coming down past 38.2%, and we're right into that 25% level again. Now you're probably thinking, well, hang on, there's two 25% levels here. So let me just reiterate. This is the 25% level going from 2022, okay, because we're using both levels. This is the 25% level going back to 2020. So we're using these medium term and then long term ranges to determine how far in price has currently fallen. So we're currently down at that 25% level. Now, generally speaking, if price breaks the 25% level, it targets the 50% level next. That would be the next obvious zone. And if it can stay above the 50% level, then it indicates strength in the market. And if it can't stay above that 50% level, then it indicates weakness in the market. So that's what we're kind of looking for here. So we're down at that 25%, which is the long-term level. And we're at the 38.2%, which is from 25 to 38.2. Hope you're keeping up with that. So the red ones, to keep it simple and in context, the red ones here, the dotted red ones, I should say, are the short-term Fibonacci retracements, and the long black one, so the straight black one here, that's the long-term Fibonacci retracements. Okay, so that's how we're breaking it down. Now the next one that we have here, so we can see that price has broken through the 25, broke through that 38. Now it's hit down to this 25% level of the longer term range. If we go back, we can definitely see that there's a lot of possible support around this zone, so that's good to see. But the next level that we're watching is this green trend line moving higher, okay? Now this is a valid trend line, okay? So it's not an invalid trend line, it's correctly drawn. And if we trace it backwards, we can see that it starts back over here in 2020. So price came up, it fell away, came down to this trend line. The trend line wasn't visible until we drew it in after, by the way. And then price came up, fell down, another touch, price moved up, fell down, and now we're coming towards this trend line right now. Now, for those of you wondering if this trend line is correctly drawn, we have very simple rules for trend line drawing. So if I pop in this price measure, the rule is simple. To draw a trend line, we can use peaks and troughs out of the zone. So rule's simple. If the trend line is within 2%, okay, then it is a valid high or low, okay? So this is coming in at 1.3%, so we can technically draw it, even though it's not exactly touching that low, okay? So that is a trend line rule, and we follow it, simple as that. So if we're following it and it's working, then we keep going out. So this is the danger part right here, is that we are now coming to this long-term trend line, and where the price comes down and rejects it or breaks through it, well, that's going to give us the zones to be watching for next. So if it breaks through it, we're heading down to this 50% level. And if it breaks through that again, we're heading down to a cluster. Now this cluster is 175%, which is measuring this range. So let's go ahead and draw a pencil. Again, just remember, I'm not a good artist, so don't ever expect my drawings to be going down. So there goes 1, 2, so that's the ABC, and then this is 175%. Okay, so you got A, that's an A, this is a B, this is a C, okay, and then we're extending down 175%, and that brings us into this zone right here. Okay, then we also have the 61.8% zone. So if we break 50%, we're going down to 61.8. Okay, and then if we break this 25%, the next one down is 38.2%. So we got a bit of a cluster here between some different zones, and that's why we are watching this zone right now. Okay, so the other thing in here is the square of 9. So the square of 9, we have 360 degrees falling in here. Okay, so that's another level that we're watching. And the 360 degree in the past has provided support and resistance. So we had resistance to the move higher here. We had resistance to the move higher right here, with some support and resistance along the way here. So it has been acting in the past. And we're coming down into this zone right here. So this is a square of 9 level. I won't explain it just to keep this video standard, not too long. Alrighty, so let's go ahead and now delete these. So what we're left with is we're left with some boxes, so that we leave these two boxes on the chart, and this is now the reasoning behind where we could be heading. Just keep in mind, if I just draw it in once more, our pencil, we have that trend line coming up somewhere around here. Okay, I don't exactly know where it is, but it's coming up pretty much around here, and it's a very critical long-term trend line. So now we're going to take a look at some other things, and we're going to go back in time for that, okay, because this is going to be important if we want to determine if we're likely to be an end of 18.6 year crash, or if this is just some form of flash crash, which will then resume the long-term trend higher. So I'm not going to break down every 18.6 year cycle, but let's take a look backwards and let's just see what's occurred in the past. So the very first one we can see here is we have quite a flash crash right here. This is 1929, okay? So we have a price measure tool, bring it down the average right here, moved 188 points. As a percentage, that is 48%, and it moved that, so we'll do a time measure. We just want to track how many days or how long it moved it. It moved it that 50% basically over 75 days, okay? So 75 days the market had topped and then bottomed. If I get my pencil, okay, so this down to here, we can see all that. And then the market moved higher. But one thing it never did is it never broke that top, okay, and that's important, okay, because that could be a critical zone or a critical information for us to be watching. So what I want to do, sorry, is I want to put on a price retracement. Now if we do the price retracement here off this zone, we'll see that it came up to the 50% level, didn't break it, and then proceeded lower. So that's going to be important for us to be watching. If this is the end of the cycle peak, then we'll be expecting a repeat of this where it comes up into this critical zone. If we do get sort of a repeat of this, doesn't break it, and then trends lower and breaks the old lows. That's the end of the cycle. That's it. We're over. We're going down for the next 18 or 24 months or whatever. That would be sort of my thinking. Let's move forward. We don't really see any major flash crash from an end of cycle period here. This is just not really end of cycle. It's kind of mid-cycle-ish. Nothing there for end of cycle. Again, you can see these flash crashes happen, and they happen quite often. And the market comes out of them and they reverse. We're looking for even this one right here, 1950. Okay, so I don't want you to be fearful when these flash crashes happen. We just got to know, so this was over 35 days or so. And then the price measure of that, so what's the percentage move? Fell 34 points. If we change that to a percentage, fell 15%, okay? The market came down over 35 days and then started to reverse after that. Okay, so we're in that point now where we're having some sort of flash crash. Let's go back to 1987. Okay, so 1987 was an end of cycle crash. Okay, and it was 60 degrees or 60 days roughly. And it bottomed, or it fell, roughly 40%, okay? 40% in 60 days. Then the market had advanced from there. It then had its real estate cycle low around 1991 to 1992 period, okay? But the stock market had continued to advance during this time frame. Then we had the 2007 to 2009 period where the market fell for around 515 days, and it fell 55%. Okay, let's go forward again, because now we're going to come up to where we are now. So the first of all, we can see that if we're counting from the top, let's go out a bit. If we're counting from the top here to the bottom of the move, we can see that 55 days has already passed. Okay, so we're not getting a 55-day repeat from there. If we go out from this top to out to here, we can also see that we're not really getting that 55-day repeat. We're kind of stretching 60 days perhaps, okay, which is totally okay. 60 days perhaps. We're moving from high to low within 60 calendar days. And then we're going to get possibly a 15% decline. So we'd already measured the decline here, 15%. Then a reversal. That would be acceptable, okay? If the market is to decline from here, and it is to fall that 50% range, I told you that was going to take us back to around 2020 levels. So 2020 levels. This would be a 555 calendar day decline, and that would take us out to June 2026, which would be putting us into a low probably 1.5 years early. I wouldn't write it off if that's going to be the case. It means that the next bull market's going to start early. However, the price level that we'd be looking at would be around, this is 45% here. If we go down to 50%, we're looking at 20,000, which would take us back to the 2020 lows. So around this time, around this price range, we're looking at those 2020 lows, and that's sort of what's on the cards. If the top's in, okay. Now I don't think the top's in. I think we've got a little bit further to run. I could be wrong, but that's just my bias. Okay, my bias would be leaning towards a little bit further to run over falling. So we'll have to see what happens in this case. Okay. So let's go back to that major theme that I had been warning you about for a little bit. Okay, so just remember, just so you are fully aware, that once the market broke that 11th week, okay, or that 12th week zone, and it broke this point right here, we're in a technical bear market, okay, and that occurred right here. Now the unfortunate thing about being in a technical bear market means that to be in a technical bull market, we need 12 weeks moving higher. That's the downside to this. So between now and 12 weeks moving higher, which is a 3-month time frame, we will remain in a technical bear market, okay? That means prices can move higher, lower, higher, lower, higher, lower, but it must move higher into its highest high after 12 weeks to be changing the trend from a bear market to a bull market. And at no point can it continue to make lower lows, okay? Because at each point that it makes a lower low, we have to start the count again from that new low. So once we get our first week reversal, if we do get a first week reversal, we can then start counting higher, higher, higher each time until we get 12 weeks. And until we get that 12 weeks, just to reiterate once more, just so you're perfectly clear, we are now in a bear market. Well, we have been in a bear market since this point right here. And we need to be treating this as a bear market for the time period, okay? Now, am I saying at all that this has not happened in the past? No, not at all. Okay, this period right here, we were in a bear market, okay? And I've gone through this many, many times. If we look at this period in here, I know we broke that, so 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This period right here, we were in a bear market. But does that mean that the market can't reverse? No. 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Once it broke this high right here, we then moved back into a bull market. Simple as that. So yes, it can reverse, and that's what I'm trying to say to you, is it can reverse. But each time it makes a lower low, or each time the market moves lower than the current low, we have to wait one whole week for that low to come in before we can start counting our bull market move higher, okay? Something to consider. Now, if we move to the SPX, okay, so the SPX has fallen 17.5%. Let's just move it to the weekly. Let's go over a little bit. We're going to count the top here. So 0, 1, 2, 3, 4, 5, 6. It's only had 6 weeks down, so the SPX has not yet confirmed, which is the top 500 shares. Okay, so the top 30 has confirmed a bear market, but the top 500, which is the broader index, has not yet confirmed bear market. Okay, so we can still reverse from here without having to count the bull market higher. That is still possible, but we're roughly 6 to 7 weeks down. 1, 2, 3, 4, 5, 6. Yep, moving into our 7th week now. So if we get 12 weeks or more, then we can define it as a bear market. So that's just something to be considering. Now, if price continues to fall from here, the obvious zone is that 50 to 61.8% zone. We have broken that 38.2% zone. It's okay to wick through it a little bit. Okay, so it's okay to go through it, zip a little bit, and then reverse. That's totally okay. However, if we keep falling from here and it's got a very strong close, we might fall a little bit lower and then reverse. I'm looking for that possible reversal, the time by solar degrees count, I should say. I'm looking for that possible reversal on the 7th. Okay, and if it continues lower, then we look for that mid-month cyclical low. Okay, so we're still not out of the water yet. That's what I want to stress. We have a little bit more ways to go. However, you know, we got to stick with it. We got to be either on the sidelines or defensive right now. We can't just be bullish. Okay, when we can be bullish is when this market structure changes. Okay, just reminding you that technical bear market on the Dow Jones. That's important to know. Okay, so let's go to the XJO. So the XJO currently has fallen, which is the Aussie 200, has fallen 10.4%. Okay, so from its top down to the bottom here, it's fallen 10.4%. Is that unusual? No, not at all. In the past, we fell more than 10% here, and before that, we fell 13% back here. Here we fell 20%, so this is 2014 to 2015. Is it unusual? No. Does it signal the end of the the end of the bull market? No, not yet. If we go to 2007, and we just do a quick glimpse of this, because this is, for those of you who still haven't cottoned onto it, 2007 was the end of the 18.6-year cycle, and that means that we'd be watching for moves similar to it, okay? So currently we had fallen on, it's probably not a one-to-one replication right here, if we're going to factor in time. So let's go ahead to the time bit. I'm going to just pop in time measure. From the top to this low, around 55 days. Let's go back to 2007. Time measure, we'll go up 55 days. So roughly around here. So the first move down was 11% over that 50-day period. If we go back here, we're down around 11% over that 50-day period. So that is syncing up currently. Now, if we're going to continue lower, we're going to be continuing lower for a very long time. Okay, so this is, just remember, like this crash lasted about 500 days. Okay, so we've got to keep that in mind, that we could be in, once this top is in, once the top is confirmed, and it's too early to confirm on a 10% decline, because confirming a cyclical top on a 10% decline when we could be falling, you know, 50-60% over the next 500 days within, you know, 40 days or 10 days or 20 days, it's too early. Okay, we can still reverse from that because it's happened in the past and it can still happen again. So we need to be just keeping our risk adjusted returns in mind. Okay, so we don't want to be going balls deep in anything that we're doing, and just knowing that the end of the cycle is approaching, and whilst I still maintain a slight bullish stance on things, we need to be well adjusted that if this continues to go lower, we need to be knowing where we're getting out of the market. So for the XJO, 0, 1, 2, 3, 4, 5, 6, 7, we've had around 7 weeks down, haven't confirmed a bear market just yet, which means that we can still reverse from this safely and continue to trend higher. Now, when we watch the real estate stocks, we look at the real estate stocks in the broader context of the 18.6-year cycle. And generally speaking, the real estate stocks will tell us if we're at the end of the cycle. Now, that's because the end of the 18.6-year cycle is usually a credit-induced bust. And everyone is feverish on real estate. Real estate is skyrocketing. And this is the end of the 18.6-year cycle, okay? So generally speaking, once this occurs, this brings down everything. This is when the banks crash. This is when the economy tanks. We go into a global depression, at least for temporary. Remember, everything in the world is temporary. Okay, nothing is permanent. Nothing lasts forever. So we move in and out of these phases. Okay. So the key points that we're watching is obviously this old high. Okay. So if this is broken, you know, this is still quite far away from here. So probably another 10% drop or something. So we move down 50 points. Percentage, 20% decline from where we are now. Obviously, that's quite a steep decline for a real estate stock, REA Group. However, we can see that the trend is still currently up and long-term up. Okay, so it did suffer for a couple of weeks during 2021 to 2022, but has been on a steep advance since, and is now 3 weeks down. Okay, so, sorry, this is monthly. So let's go to here. So 1, 2, 3, 4, 5, 6, 7 weeks down. Okay, that's it, 7 weeks. So we haven't hit the 12 weeks yet. Once we get 12 weeks, then we would be concerned about a possible bearish move in property and also issues in the banking sector. GMG, a little bit different. Okay, so it's coming down. This is Australian as well. Coming down to this zone here. Okay, so if we don't get a bounce off this zone, that is quite concerning. But to put it into context, this was 2006 to 2007 period. And this was 2009. So these are the kind of the drops that we can see in these stocks after they peak out and just crash during the credit-induced bust, okay? And if we use this one and go back to that 2007 to 2008 period, we can see here we spent several months going downwards. So from 2007 all the way down to that 2008, 2009 period. So it spends several months going down. And if we look at the price percentage moves, so this top up here to this low down here, it's around a $4.50 move on the stock, okay? However, it was a 60% decline over that time period. So put it into context, let me just bring this one up. we're down roughly 20%. Okay, so we still have, you know, another 40% decline if we were to repeat that. So 60% would take the stock down to around $100. But given that it's starting on such a high base, I wouldn't be surprised if it, you know, comes down to this $50 levels, at least down to these 2020 levels. That would be not out of the ordinary. AMT, which is American Tower Corp. I don't really know what they do, but it's listed in the real estate markets. Okay, so if we take a look at 2000 to 2002, you see these long steep declines. 2007 down to 2008, 2009 period, these declines here. Now this goes from roughly $47 down to a low around $19. So you know we're 50% off. And right now what we can see is we're in a long-term move higher. Okay, so this is a monthly chart. Let's change it to the weekly chart. And we can see, let's go over a little bit more, that long-term bullish, okay? And even short-term, if we go into here, we can see that we have our lowest low up here, we have our highest high up here, currently trading between the range. So this is actually quite important. I'm going to put a retracement on this zone here. We're above the 50% level, okay, so as long as we remain above this level now, and we could be breaking this high just right here at 244, trending higher, but it's not going to trend higher for much longer, okay, because we're at the end of the cycle, and I'm expecting soon to get signals that this market's moving down, and we'll see that market moving down as soon as we get, you know, breaks below these lows, okay. Once we get those change of structures, we no longer break this top here, we start moving down, breaking between these lows here, then I'd definitely be looking down. And then Well also is Welltower, which is a US market stock, and we can see this is giving us blow-off top-ish vibes, yeah? That's giving us that blow-off top-ish vibe where we went from $25 in 2020 over to $160, okay? Blow-off top-ish vibes where we got this massive incline. We look at the weekly chart because we're counting bars. We got 1, 2, 3, 4 weeks down, that's it. We got critical zones, which I'd say is this low right here. Okay, breaking that low would be critical, and then coming down to these zones down here would also be critical. So we'll see what happens in price there. Right now, there's no reason to believe that the real estate market's turning over, which gives me reason to believe that we might still have a little bit more to run. I'm not saying that they're not going to correct and fall as they move up and down, but we might stabilize around here, if not advance higher for a little bit longer. That would be the ideal situation, because what we would usually see is these real estate stocks start to turn before the stock market. That's what we'd usually see. So we'd be seeing something like this where we have this market moving down for a long time. Not really a long time. Generally 6 months to 8 months is the average. So this topped out in 2021, so it's actually not a good gauge. So we'd probably be using this 2024 top or even another top that occurred, and would be seeing it trend down for around 6 to 12 months before everything else moves down. Because we're not getting a broad sell down on all assets for 6 to 12 months yet, and now we can see that the trends are still higher. The trend is still higher in the zone, and we're only selling off now in the last month or so. Okay, we still have possibly more room to run. So I don't want to bore you any more than this. This is a long video, going over a few things right now. Bear market on the Dow Jones, just to reiterate once more, just so that we are all on the same page. However, we have been through this before and we will go through it again. I don't want to continue to maintain a bullish stance, but I just think being a bull right now is better than being a bear, because when this flips, that could be dangerous to you. So there is nothing that Trump wants more than a falling stock market. So he's going to negotiate with different countries, different tariffs and things like that. Generally what Trump does is he slaps on and takes off. So we'll have to see how the markets react to this slap on takeoff, but he's done it a few times already. And we'll just have to see how it goes. No administration can make a depression, and no administration can make the economy boom. Okay, it'll happen on its own accord, as McWhorter says, and we need to just be moving with it and not against it. So if the market is going to move down from now, we need to maintain that position and move with it, but we need to know where we're flipping it. So yes, we're in a technical bear market on the top 30 stocks, for example, on Dow Jones, but we haven't confirmed that yet on the SPX. Yes, we're declining, we're getting a correction. You know, we did that in the past, but we're not in a technical bear trend just yet. So maintain position and look after yourself, guys. Look after yourself, okay?